Cambridge IGCSE Accounting Paper 1. This is taken from the May-June 2019 session. This part of the video will only be showing the first three questions. So if you're not stuck on either of these, then you can skip forward to another part. So let's just start. Question 1. These are MCQs. Part A. Sorry. The employees of a business are highly skilled, but this is not recorded in the financial statements of the business. Are highly skilled, but this is not recorded in the financial statements of the business. Which accounting principle is being applied? Alright, so right off the bat, you should be able to tell that because skills are not something that you can physically value in terms of money. So this most probably has to do something with the money measurement concept. Even if you're not familiar with the concept, you should be able to tell that it has something to do with money measurement, because you can't measure skills with money, right? So that is going to be the answer. If you look at the other options, going concern, that has nothing to do with this in this case, because the going concern concept says that a business is going to be trading or doing its stuff in the foreseeable future. That has nothing to do with it. Prudence says that profit and assets should be understated, so that has nothing to do with this as well. But in a way it does, but if you're not clear whether skills are to be recorded or not, then you may get confused with this. But in this case, it's not going to be the example because skills are not to be recorded in the financial statements. Derealization concept, no, just doesn't have anything to do with it. Part B. Khalid started a business on the 1st of April 2018 with a capital of $90,000. He provided the following information, and there's some non-current assets, current assets, current liabilities, and drawings. So yeah, there's an easier way to do this rather than trying to remember the format for the balance sheet in your head. You can just use the simple accounting equation, which is going to be total assets equals to total equity plus liabilities. So we have assets, we have the liabilities, and we have part of the equity. We have the capital, and then we have the drawings. And as you know, the third thing in under equity in the balance sheet is actually the profit. So once we've equated this equation, then we should be able to tell whether it was a profit or a loss. So adding up, let's just add assets first. That is going to be 75 plus 32 equals liabilities, which is going to be 24, and then we're going to add 90, which was the capital in the first year. In the brought down capital, and then we're going to add we're going to subtract the drawings because they go against capital. So that's going to be minus 19, and then we're just going to add x. Or even if you don't want to add this, you can, and then to balance it off, you can tell whether it's a profit or a loss. So when you add both of these sides, it's going to be 107 here, and then it's going to be 24 plus 90 minus 19 is going to be 95 plus x here. And then when you solve for x, you're going to get 107 minus 95, which is going to be 12,000. Right, which gives you a $12,000 profit. Alright. Part C. How is cost of production calculated? Alright. Part A says direct materials plus labor plus expenses. Alright, that's fine. There's no error in this. Materials, labor, expenses, and factory overheads in Part B. This is fine as well. This is completely correct. There's no problem in this. But when you take a look at option C and option D, there's an additional thing in this, which is work in progress. So, and the only difference is whether to add or subtract the work in progress. So this is going to be either of these because there's something missing in part B and A. So it's got to be either C or D. Now, work in progress is the unfinished goods that you left off last year. Now, if you pay a bit of attention, you will know that to complete something that is incomplete, like for example, if I make chairs and I completed half a chair last year, so to complete the half remaining chair, I'm going to have to put in money. It's going to cost me money. So I'm going to have to add the decrease in work in progress, because when you add the cost of completing something, that is going to decrease the half finished goods, right? So add decrease in work in progress, because the decrease in work in progress means that you finished half finished goods, and that cost you money, so that is going to be added into your total cost. So the answer is going to be C. Part D says Lisa returned goods previously purchased from Tara. How did Tara record this? Right, so uh, the most important thing would be that you're going to be recording this as Tara, which is a supplier, and Lisa is an asset and a customer for Tara. So returned goods previously purchased. So we all know that for anybody who sells goods, sales are credit because it's an income, right? And sales returns are credited. We know that, right? So in this case, Lisa returned goods. So that means that we're going to have to credit Lisa's account, which is going to be Lisa's account. So when we credit Lisa's account, we're going to have to debit the purchases returns. Sorry, the sales returns, right? Because the sales returns is a debit in nature, because it's an expense. So the answer is going to be D. Don't get confused with with option C, because purchases returns is not the thing. It's not the option in this case, because it's a sale return. Lisa purchased goods from Tara, which is a sale for Tara, and then she returned goods, which is going to be a sales return for Tara. Right. Part E. When preparing his financial statements for the year ended 30th April 2019, Tebogo recorded his opening inventory of 6,400 as 4,600 in error. Right, so this means that his opening inventory is understated, because his inventory was actually worth $6,400, but he wrote it as $4,600 in error. Right, so what was the effect of this error? All right, so effect on the gross profit for the year. The gross profit is obviously going to be overstated. Why? Because let's just draw a mini income statement here. There's going to be sales at the top, and then we subtract cost of sales from sales, right, in the income statement. And under cost of sales comes opening inventory. So if the inventory is understated, sorry, let me just write that with another color. If the opening inventory is understated, that means that the cost of sales is understated as well. So if the cost of sales is understated, then that means that the gross profit, the gross profit is going to be overstated. Because, for example, if we have 50,000 for 50 sales, and the inventory is originally is 35, but we accidentally wrote it as 20, for example, then the gross profit is going to be 30 and not the original 15, because the opening inventory is understated. So the gross profit is going to be overstated in this case. And because the gross profit is overstated, then the net profit, or the the profit for the year is going to be overstated as well. And because the profit of the year is overstated, we all know that the profit for the year is actually included in the capital in the balance sheet. So all these three are interconnected with each other, and all of them are going to be overstated. So A is the answer. Alright, sorry. Part F. Amrick started a business on 1st January 2017 and purchased a machine costing $18,000. He decided to depreciate the machine at 20% per annum using the reducing balance method. No depreciation was to be charged in the year of disposal. Alright. And then he says that the machine was sold for $13,300 on 1st July 2018. What was the profit or loss on the sale of the machine? So, alright, 1st January 2017. Now you have to keep in mind that he said that no depreciation is to be charged in the year of disposal. So that means that from 1st January to 1st July 2018, this we're not going to count any depreciation for this, because from 1st January 2018 to 1st July 2018, this was the year in which the machine was disposed of. So we're not going to be counting any depreciation, because he said that no depreciation was to be charged in the year of disposal. So that means that we're only going to be putting in 1 year worth of depreciation. That is going to be $18,000 into 20% of that. You could do that the easier way, which there is one, but I'm just going to do this. That is going to be $3,600 of depreciation, and then we can get the net book value by decreasing that, subtracting that. That is going to give you $14,400. So this was the actual book value of the machine at the time of that it should have been sold to break even, but he sold it for $13,300. That is obviously a loss, and subtracting $13,300 from $14,400, that is going to give you a loss of $1,100. Alright, so part G. Financial information must be free from errors and bias. To which accounting objective does this refer? Right, so we all know that, yeah, obviously the answer is going to be C, reliability, because if any financial information is free from errors and bias, then it automatically means that the information is reliable, because one, it does not have any errors and is free of bias. So comparability, you can compare it if it's free of errors, but it can be biased in comparability. Relevance can only be if it's free if it's free of errors, right? If it has errors, then it's relevant, but if it doesn't have errors, then it's relevant, but if it has bias, then it can't be relevant. And understandability, that just doesn't make any sense, because you need reliable data. So part H, alright. Amelia rented premises to a tenant. At the end of Amelia's financial year, the tenant had paid 2 months rent in advance. Right. Fine. So which entries would Amelia make in her ledger? Right. So Amelia rented premises to a tenant. Right. So she's the owner of the premises. At the end of the financial year, the tenant had paid 2 months rent in advance. All right, so we know that rent receivable is a credit account because it's an income, right? So because it's paid in advance, she's paid 2 months advance to Amelia. So that means that we're going to have to debit the account. Right, we're going to have to debit the account by whatever value. For example, if it's $500, right? So we're going to have to debit the rent receivable account by 500, because now we don't owe anything to the tenant. Sorry, they don't owe anything to us because they've paid us in advance. So technically, they're a liability for us now. So we're going to debit the rent receivable account. And then obviously, because it won't balance with only a debit, with only 500 on the debit side, so we're gonna have to carry the amount down on the credit side. um, I hope that was clear, but let me just explain it again. Because they've paid us in advance. Now, if you should know that any income that is paid in advance is actually a debit, because it's not an income anymore. The customer becomes a liability for the business. So we debit the amount that they've paid in advance, and then to balance the rent receivable account, we're going to have to carry it down on the credit side, because there's no other way to carry it down anyway. So the answer in this case, yeah, is D. Right. Part I. John paid Tahir, a credit supplier, $200 by check. Right. This was credited to the account of Tarek, another credit supplier. Right. Which journal entry corrects this error? Alright, so he's trying to confuse you here, because there's technically two suppliers. There's two suppliers and one customer. So Tahir and Tarek, both of these are suppliers. The amount is 200 by check, and John is a customer, right? So because we know that credit supplier, alright. So when you uh, sorry, paying a supplier is debit. We all know that. Why? Because when you pay someone, it's an expense. Alright, so expenses are debit, right? So, and he says here that this was credited to the account of Tarek. So this here is an error by itself. So to compensate for this credit, this unwanted credit to the account of Tarek, we're going to have to debit 200 to Tarek's account, right? To cancel this, to cancel the unwanted credit onto his account. And the original entry should have been a 200 debit to Tahir's account, because you're paying him. That's an expense, so that's going to be a debit. Or you can say a purchase for this man. Purchase is an expense, so that's going to be a debit, right? And the to balance both of these entries, the suspense account is obviously going to be 400 credit. Alright, so Tarek's account was credited. We don't need that. So to cancel that, we debit the account by 200. So there's no, so this that cancels the effect onto Tarek's account. We paid Tahir. He's we we purchased from Tahir. That is going to be a debit to Tahir's account by 200, and to balance these, that is going to be a suspense 400. So the answer is C. Right. Part J. So he's given us some information: opening inventory, closing inventory, purchases, and revenue. And he says, what was the rate of revenue turnover? So we know the formula for the rate of inventory turnover, and that is in times. He's asking for in times. So that is going to be, whoops. Alright. That is going to be cost of sales over average inventory, and that is going to be the formula. So in this case, the cost of sales is going to be we're just going to have to calculate it by this ourselves. That is going to be purchases, add opening inventory, subtract closing inventory. That is the normal format from the income statement. So adding that, we get 360 plus 36 minus 24. 24 is a closing inventory. We subtract closing inventory from the cost of sales in the income statement. That is going to be the case here as well. Average inventory, which is going to be 36,000. You can see opening inventory and closing inventory. The formula for an average, anything to take out the average is adding both of them and then dividing by the number of things you added. So that is going to be 36 plus 24 divided by 2. And when you get that, when you add the cost of sales, that is going to be 372, and then the average inventory is going to be 30, and that gives you a rate of inventory turnover 12.4 times. So the answer is going to be B. Olivia is a trader. Sales and purchases are made on both cash and credit terms. Olivia maintains a full set of accounting records and prepares control accounts at the end of each month. Alright, so Part A, name the book of prime entry which Olivia would use to obtain the following information when preparing her control accounts. Right, so this is something that obviously you must have memorized from whatever textbook you're following uh, from school or whatever. Uh, we know that the returns to credit suppliers is in the purchase returns journal. Purchase returns journal. There's no concept to this, you just have to memorize them um, either from the internet or whatever book. And the checks received for credit customers, that's in the cash book. Contra entry and bad debts written off, they don't have any individual books for themselves, so that is going to be in the general journal. General journal and general journal. Alright, so part B. Complete the table by placing a tick in the correct column to indicate where each item would appear in Olivia's sales ledger control account. Alright, sales ledger control account. You should have memorized the format for the control account. If the item does not appear, a tick does not appear, place a tick in the no entry column. Alright, credit sales. We know that that's on the debit side because it increases the sales control account. Sales ledger control account. Sorry, cash sales, they're not included because that's not the point of the control account. Cash refund to credit customer, that is going to be a credit because it counts against the credit sale, right? It decreases the sales, so that is going to be a credit. Right? Cash discount allowed by credit suppliers. The examiner is trying to confuse you here because suppliers, cash discount from suppliers, that has nothing to do with it because it's a sales ledger control account, not purchases ledger control account. Contra entry is always against the brought down, mostly against the brought down, so that is going to be a credit because the brought down is mostly on the debit side, so that's going to be a credit. Trade discount allowed to credit customers, that is not included in the control account, that's in the ledger. Interest charged on credit customers overdue account, that is going to be a debit because it's an income from sales, because if somebody didn't pay you on time, you tell them that I'm going to charge interest on you, and that counts as a sale, so that's going to be a debit. Part C. State the meaning of the following terms. Bad debt. So bad debt is an amount that is owed to you by a customer, but that is not now going to be paid. So you can write that in your own words. An amount due by a customer not going to be paid. So that's an expense. Bad debt recovered is an amount that was written off as a bad debt but then you out of the blue you receive it from the customer. For example, if somebody owed me 500 and at the end of the month they didn't pay me, and I thought that, oh, maybe they're not going to pay me ever, and then next month he comes over and he says, hey man, here's the money I owed you. So that's going to be a bad debt recovered, an amount due by a customer that was previously written off but then received or recovered. That's a bad debt recovered. Provision for doubtful debts. So a provision for doubtful debt is actually just a predicted or an estimated amount of bad debt that is going to be written off in your books in a year. So, for example, if you have sales of about $100 a month or a year, then you think that, hey, maybe somebody is not going to pay me, maybe. So you just stay on the safe side. You decrease some of your income to that, and you add that as an expense when it increases or decreases the provision. So that is going to be that. It is a predicted or estimated account for a bad debt in a year. Right. So part D. Olivia's financial year ends on 30th April. On 30th April 2019, Olivia owed $200 in cash, received $200 in cash from Ben, a credit customer, in final settlement of the amount he owed. So that if you just read it as that, you know that something's wrong, because in final settlement of what he owed, that means that he didn't really pay the full amount, and that is proof right here. There's proof here. The balance of Ben's account was written off as irrecoverable. The balance. So that means that $200, and there must have been something more than $200 that he owed, because the balance of it, the examiner is telling us to put that in our books as a bad debt or as irrecoverable money. So that's going to be a bad debt. And then he gives you part D is actually to complete the following accounts in Olivia's ledger for the year ended 30th April 2019. And you can see here that Ben's account, he actually bought goods from Olivia worth $360, and then he only paid $200. So that is actually going to be in cash. So he paid cash $200, and then the balance of it was actually a bad debt. So that is going to be a bad debt. Bad debt of the remaining amount, which is going to be $160. So you received cash, so that means that the cash is going to be debited by 200, and the Ben account is going to be credited by 200. Bad debt. Bad debt is an expense, so the bad debt account is going to be debited by 160, and the Ben account is going to be credited by 160. So that balances off 360, right? Bad debts account. So you're just going to add here because it's from the Ben account, so that is going to be Ben, and that is going to be 160. And when you balance these off, that is going to be 544. That is going to be balance carried down 544, and then you have to bring this up again for that extra mark. That is going to be 544. Yeah. So that's that. Part E. Olivia maintains a provision for doubtful debts of 3% of the trade receivables at the end of each financial year. On 30th April 2018, the trade receivables amounted to $13,500. And on 30th April 2019, which is exactly 1 year later, the trade receivables amounted to $12,800 after writing off Ben's account. And he says for us to make the provision for doubtful debts account. So we all know that all provisions are credit, right? PAC. Provisions are credit in nature. So the balance brought down for this is going to be 13,500 at the 3% of 13,500, which is going to be $405, right? This is for the first year. So for the next year, you must put in dates. By the way, I'm not putting any dates. You have to do that yourself. Balance brought down. So next year is actually going to be in the form of income statement. So let's just calculate it. 12,800. We can see that it has decreased. So 12,800 into 0.03, 384. So the provision has actually decreased on 30th April 2019. And because it has decreased, we're going to have to credit the income statement and debit the provision. So this is going to be income statement. Sorry for the short form. This is going to be 405 minus 384. It's going to give you 21. So in the income statement, you're going to under the incomes heading, this is going to be a decrease in provision for doubtful debts by $21, right? And then the balance carried down obviously is going to be 405 minus 21, which is going to give you 384 again, and then you're just going to carry this again. Balance brought down 384. So that's that. Let me explain that again, because 13,500, which is on 30th April 2018, the 3% of that is 405. That's the balance brought down. Next year, the provision has become $384, which is decreased from last year. So you're going to debit that by $21, and then you're just going to balance off the account, right? He says Kadir is a food wholesaler. Wonderful. He maintains a full set of accounting records and prepares a trial balance at the end of each financial year. And part A says state 2 reasons why a trial balance is prepared. So the first important reason is to help prepare financial statements. How? You make the income statement using the trial balance, right? So you have all the debits and the credits, and you just have to put them on the income statement format. So that helps to prepare financial statements. Part two, the second reason is actually that it helps to confirm whether all the credit and debits, or in easier words, the double entries, were actually correct made during the year. So how do we know that? We know that because the debit side and the credit side of the trial balance are balanced, right? So using the trial balance, we know that all the double entries, the debits and the credits, were all correct, and that it balances at the end. So that's another reason. Correct that. Double confirm that. Sorry, entries made were correct, right? Part B. Name 3 types of error which are not revealed by a trial balance. Give an example of each. Alright, so let's just start with the easiest, the error of reversal. Right? So for example, if you bought goods from somebody and you accidentally, the normal entry would be to debit purchases and credit cash, right? And you accidentally credited purchases and and debit cash, right? And debit cash, which means that you actually received cash and that credit purchases. That just doesn't make any sense, right? So you accidentally reverse the entries. So error number 2 is another easy one. Actually, this should have been first if we're ranking by how easy they are. So error of omission, which is that you just completely forgot, you just totally bottled it and forgot to put any entry. For example, not writing off bad debt, or for this matter, drawings, right? So you just forgot to record this, any bad debt or drawings. You just forgot that. So that's the error of omission. And the third error is going to be error of principle, which says that you accidentally you made an error while recording a transaction of the same class of of anything you were trying to record. Like for example, you received an interest, right? So that actually has to be credited on interest receivable, and you accidentally credited the interest payable. So you can see that the nature of the transaction, which is in this case credit, is correct, but you actually made that to the wrong account of the same class. So you accidentally credited interest payable instead of interest receivable, right? So same class, correct entry, but wrong count. So that's going to be that. Well, so right, so here's a lot of information. Maybe he's asking for an income. No. Excuse me. Prepare the trial balance. Right, he's asking for a trial balance. Right, that is not a problem. Right, so we know that. Right, so I think mostly if you're having a tough time with this question, it means that your debits and your credits, they're not very strong. So you can just remember that by dealer, right? Just make a T account here. So this is actually drawings. D is drawings. E and A are assets, and E is expenses, right? So drawings, expenses, assets, and these the L is liability, the E is equity, and the R is revenue, right? So just keep that in mind, and this shouldn't really be a problem, right? So revenue is actually revenue in purchases. Let's just write that down. That is 146 and 137 300. So the revenue is credit in nature. You can see that right here. So that we're going to have to debit that by 146. And the purchases, we can see right here, purchases are expenses, so that is going to be a debit by 137 300. Sales returns, that is actually a debit as well, because it counts against the sales. That's an expense. Sales returns is an expense, that's a debit. Carriage outwards, 2970. Carriage outwards, which means that carriage outwards is basically an expense, right? So that if it's an expense, that is going to be a debit. So 2970, sorry, 2970. Right. Fixtures and fittings at cost, and motor vehicles at cost. At cost means that he's talking about an asset, and assets are debit in their nature, right? So that's going to be 45,000 debit. Provision for depreciation of fixtures and fittings. All provisions are credit, right? So that is going to count against that, and it's depreciation anyway, so it has to count against that. Credit. So we're just going to put that on the credit side because it counts against the the value of the asset. So 18,000 credit. Motor vehicles, an asset, that is going to be 16,850 debit. 16,850 debit. Discount allowed. An easy way to remember this is by using the word DAD, which is discount allowed debit. So discount allowed is always debit. So 190 debit. 190 debit, and because discount allowed is debit, so discount received must be credit, right? That is going to be by 230. Trade receivables and trade receivables. That is going to be 14,600, 12,900. Trade receivables are an asset, so that is going to be a debit, obviously, and trade payables are a liability, and liabilities are credit, so that is going to be 14,600. Operating expenses. Operating expenses 17,190. Expenses are debit 17,190. Rent payable, another expense, that is going to be a debit as well. Commission receivable. Receivable, so it's an income. Incomes are credit. Revenue or income is uh, is a credit, so that is going to be a 2,000. Yeah, $2,000 credit. Bank overdraft actually counts against, its bank overdraft is a liability, right? Bank overdraft is a liability, or it counts against your cash, so that is going to be a credit as well. 5170. 5170. And then capital or equity is credit, so that is going to be 65,000 credit. 65,000 credit. And then inventory, what's this, right? So we have to balance this off as well. Opening inventory is always included on the trial balance, and the closing inventory, you may remember if you saw some questions, that the closing inventory is always under the additional information. Only the opening inventory is on the trial balance, so we're going to debit the trial balance by $12,000, which is going to balance both our sides by 251,000, right? So that's that. um, Running out of the battery as well. So Kader purchased the motor vehicle on 30th March 2019. He entered the total amount paid in the motor vehicle account. The total paid consisted of the following: cost, insurance, delivery charge, and fuel. And then he's asking for, yeah, capital and revenue expenditure. Give a reason for your answers. Alright, so the cost of the motor vehicle is capital. Why? Because he said that the cost of purchasing a non-current asset will be kept for over 12 months. He's fine. He's correct. So the insurance, 1 year insurance, is actually going to be capital as well, right? Sorry, I'm so sorry. It's actually going to be revenue. Why? Because he actually himself gave the most important clue right here by saying that it's going to be kept for over 12 months. So that actually implies that any capital expenditure is for over 12 months, right? Or for that reason is only paid once in the asset's lifetime. So insurance, 1 year's insurance, it means that it has to be paid every year. So that is going to be revenue, uh, as it will deplete, or finish within 12 months, right? Delivery charge is a capital expenditure. Why? Because you only pay for the delivery of the vehicle once. You never pay it again. And it's kept for over 12 months or forever in this case, right? So the delivery charge, the D charge, is applicable for a lifetime. You only pay it once. Fuel is revenue expenditure, because you have to pay for the fuel again and again and again every time the fuel finishes, right? Or is close to finishing, for that matter. So that is going to be a revenue expenditure, because um, you have to pay it again and again, and the cost is usually uh, finished within 12 months for it, right? So that is going to be uh, because this is not a one-time expense. This is not a one-time expense, part of daily expenses. So you almost, if you're driving much, you're gonna have to put in fuel every other day, right? So that is a revenue expenditure. So that's that for this part. The other questions will be on in another part of this video. So thanks for watching, and I'll see you in